Imagine watching your hard-earned savings lose value every single day. That's exactly what happens during high inflation. But what if you could protect your wealth and even grow it while others panic? Today we'll review Warren Buffett's timeless strategies for investing during high inflation, so you can stay ahead no matter how turbulent the economy gets. Ready to safeguard your future like the world's greatest investor? Number 1. The dangers of cash during inflation. During times of high inflation, cash can quickly lose its value. Warren Buffett has long warned about the dangers of holding onto cash when prices are rising. Take the 1970s, for example, when inflation surged to over 13%. People who kept their savings in cash saw their purchasing power shrink rapidly. Imagine having $10,000 in 1970 and finding out that by the end of the decade, you could buy only a fraction of what you once did. Buffett understood this well. Instead of holding cash, he invested in assets that appreciate in value over time. His famous purchase of See's candies in 1972 is a prime example. The business had pricing power, meaning it could raise prices as inflation increased, protecting its value. While inflation ate away at cash savers, Buffett's investments grew. Holding too much cash is like standing still while everything around you moves forward. Inflation chips away at its value, and without growth, your financial future is at risk. Investing in real assets, as Buffett has shown, is a far better way to protect wealth during inflationary times. If you are enjoying the video, hit the subscribe button and comment down your thoughts. If you want to explore money-making strategies, click the link in the description to start a financial journey. Number 2. Invest in assets that produce value. When inflation rises, Warren Buffett emphasizes the importance of owning assets that generate real value over time. He often refers to companies that produce tangible goods or services that people need, regardless of economic conditions. Take his investments in Coca-Cola. During periods of inflation, people may cut back on luxuries, but they continue to buy everyday items like beverages. Coca-Cola's brand strength and pricing power have allowed it to thrive through decades of economic ups and downs. Another example is Buffett's investment in Apple. While technology evolves rapidly, Apple has built an ecosystem of products that consumers rely on, from iPhones to services like the App Store. This type of company doesn't just hold value, it creates it. In fact, when inflation hit hard in recent years, Apple continues to generate significant revenue, raising its prices when necessary while maintaining customer loyalty. Investing in businesses that produce real value, whether it's consumer staples or tech services, protects your wealth. Inflation may erode the value of cash, but companies like these keep growing, adapting, and rewarding investors even when economic pressure rises. Number 3. Focus on high-quality businesses with pricing power. When inflation strikes, the true strength of a business is tested. Warren Buffett knows that the secret to thriving in such an environment is focusing on high-quality businesses with robust pricing power. Take the example of Coca-Cola, a company that Buffett has long championed. Despite rising costs, Coca-Cola has consistently passed on price increases to its customers without losing demand. Their strong brand and unique product often give them the leverage to do this successfully. Similarly, consider Apple. Even as inflation pushes up costs, Apple's products remain highly sought after. The brand's immense loyalty allows Apple to adjust prices without significant pushback from its customer base. This pricing power is what separates high-quality businesses from the rest. They provide value that customers are willing to pay for, even in tough times. High-quality businesses with pricing power can weather inflationary pressures because they don't just absorb higher costs, they pass them on, maintaining their profit margins. This ensures stability and growth, making such investments particularly attractive during periods of economic uncertainty. For savvy investors, focusing on these resilient companies means securing a stronger financial future, even when inflation looms large. Number 4. Own companies with low capital needs. Imagine running a business that doesn't require a massive upfront investment or hefty ongoing expenses, has the power of owning companies with low capital needs, a principle Warren Buffett has championed. Consider a success story of Buffett's own Berkshire Hathaway, particularly its early investments. One standout example is the investment in See's Candies. Buffett bought its confectionery company for $25 million, a fraction compared to the capital needed for more capital-intensive industries. See's Candies, with its minimal capital requirements, allowed Buffett to reap substantial profits without the burden of hefty capital expenditures. This approach shields investors from inflationary pressures because the operational costs remain manageable. Another example is the software industry. Companies like Microsoft, in its early days or more recently, companies like Zoom, operate with relatively low physical capital needs but possess enormous growth potential. These companies leverage their intellectual property and software, not expensive machinery or real estate. In times of high inflation, businesses with low capital requirements can often pass on costs to customers more easily and are less vulnerable to fluctuating expenses. This makes them resilient, rewarding investments, allowing you to build wealth even when economic conditions are challenging. Number 5. Invest in tangible assets, real estate, commodities, and energy. During periods of inflation, Warren Buffett advises investing in tangible assets like real estate, commodities, and energy because these assets tend to hold or increase in value when the purchasing power of cash declines. Take real estate, for example. As inflation pushes prices upward, property values and rents typically rise, creating a hedge against the devaluation of currency. Buffett himself has made significant investment in real estate, recognizing its long-term stability. In the realm of commodities, oil and natural gas are prime examples. In times of inflation, demand for energy remains consistent and prices often soar. Buffett's investment in Occidental Petroleum showcases his belief in energy as a powerful inflation hedge. When inflation hit in recent years, energy stocks surged in value, proving their resilience. Gold, often seen as the ultimate safe haven asset, also performs well during inflationary periods. Buffett has historically been cautious about gold, but his strategic focus on companies involved in energy production and real estate shows his preference for tangible assets that produce value in a world where money might lose its worth. Number 6. Avoid long-term bonds and fixed income investments. In times of high inflation, long-term bonds and fixed income investments can become a treacherous trap for investors. Imagine you're holding a 30-year bond promising a fixed return. If inflation surges, the real value of those fixed payments shrink dramatically. For instance, in the late 1970s, during a period of severe inflation, long-term bonds lost significant value. Investors locked into these bonds found their returns eroded as inflation outpaced their fixed income. Warren Buffett has long warned about the perils of fixed income investments in such environments. His advice is rooted in history. During inflationary periods, the real interest rates of bonds, essentially the returns adjusted for inflation, can turn negative. This erodes purchasing power and leaves investors with a diminished return on their money. A striking example of this is the plight of bondholders during the 1970s inflation crisis, where long-term government bonds delivered returns that were not only inadequate but also negative when adjusted for inflation. The investment world learned a harsh lesson. When inflation is high, the real returns on bonds can be severely compromised, making them a poor choice for those seeking to preserve their wealth. Buffett's strategy emphasizes moving away from these investments and exploring assets that can better withstand inflation, ensuring your money grows rather than diminishes in value. Number 7. Invest in yourself, the best hedge against inflation. When Warren Buffett talks about the best investment you can make, he's not pointing to stocks or real estate. He's talking about you. Investing in yourself is the most powerful hedge against inflation because your skills, knowledge, and ability to adapt will always outpace rising costs. Buffett himself in the early days of his career spent $100 to take a public speaking course. by Dale Carnegie. He often said it was one of the best investments he ever made because it unlocked opportunities he couldn't even foresee. When inflation erodes the value of money, it can't touch the value you create through sharpening your expertise. People like Buffett understood this early on. Continuously learning, improving skills, and expanding networks are all inflation-proof strategies. A real-world example is Sarah Blakely, the founder of Spence. She started with just $5,000 and an idea, but constantly reinvested in learning how to scale a business. Today, her empire thrives regardless of economic swings. By becoming more valuable through knowledge, you position yourself as irreplaceable, commanding higher income and better opportunities even when inflation squeezes others. The more you learn and adapt, the better insulated you are from any financial storm. If you like this type of content, then press the like button and subscribe to our channel.